Tomorrow marks the start of what could be a nightmare for banks and currencies worldwide. What's triggering the crisis and how will it affect you? Stay tuned. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the offshore yuan is crashing to levels not seen since 2022 and raising alarms across financial markets. In response, the PBOC ramped up liquidity injections just before year end. Is this really just a lifeline for the Chinese economy or perhaps a sign of deeper troubles? I want you to see what's developing in China could ripple across global financial markets and trigger what could be an all-out global currency crisis. And with that, let's head over to Bloomberg, where we picked today's story up with a headline: as the PBOC steps up liquidity injection with new tools at year end. And this is really just window dressing from Beijing. At least that's what they want you to understand, is that there's a demand for currency at the year end, and they just wanted to make sure the banks had enough of it to meet all the consumers who were withdrawing cash. But the real story here isn't what Beijing is telling you. What's really going on underneath the Chinese financial system that could kick off an all-out banking crisis and currency crisis starting tomorrow. The People's Bank of China conducted 1.4 trillion yuan in outright reverse purchase agreements using 3- and 6-month contracts, aiming to maintain sufficient liquidity in the banking system. And what they're calling reverse repo looks like quantitative easing, because what they did is they went to the banks and they bought bonds off the banks and gave them cash. Now, these are term contracts, meaning in 3 to 6 months, these bonds are going to come due, and that means the cash is going to come out of the banking system and those bonds go back to the banks. But why is Beijing doing this? Because there should be ample liquidity over a 3 to 6 month period, just in general, for any banking system. But one thing we're facing here is that Beijing is worried, and for good reason, because as you're about to see, their currency is crashing, and that's going to put a massive pressure on their financial system, including their banks, which we already know is insolvent. And based on the latest data from the real estate sector, it's only going to get worse. And this follows injections of 800 billion yuan and 500 billion yuan in the past 2 months through a new tool introduced in October. So we're seeing here, as we move toward the end of 2024, that Beijing is panicking. They realize they don't have the tools to stop the deflationary pulse that's rippling through their economy. They have no response to the lack of global demand outside their country, and their banking system is outright hemorrhaging. It's insolvent. So they're coming up with all these new tools, and the excuse is just the same thing over again. Well, there's a lot of demand for cash, so we need to make sure the banks had liquidity. But yet when we hear from the top banks in China, they say liquidity is not an issue. We have plenty of cash. We just don't want to lend to our consumers and businesses. We'd rather buy government bonds. And China's response is, we don't want you to buy bonds. We want you to lend out into the economy. Banks are saying no way. And so China's responses are force feeding them liquidity. But it's the underlying problem here is that money is fleeing the Chinese economy and the country in a major way, and that's setting up what could be a massive crash in their financial system. The central bank also bought a net 300 billion yuan of treasury bonds this month. That's on the open market. And keep in mind, China's been issuing a massive amount of debt. The rates in their economy are dropping in a big way, and yet they're going to the banks who are buying these bonds because they have nobody they want to lend to. Keep in mind, banks care about one thing and one thing only, and that's getting their money back. And guess what? They actually believe they're going to get their money back from the government versus going out and lending in the private sector. But China doesn't want that. They don't want the banks buying bonds. They want them lending, but that's not what's actually happening. And the PBOC has absorbed sovereign notes for 5 straight months on a net basis after starting regular bond transactions with primary dealers in August. So we can go back to the middle of last year and we can see things for the Chinese economy getting worse and worse, and yet the PBOC and the government stepping in, trying to intervene through monetary policy, through fiscal stimulus, and absolutely none of it's working. And what we're seeing now with a big plunge in the yuan is it's setting up a massive financial crisis, and the epicenter is right in the heart of Beijing. And a more robust liquidity buffer will help banks manage the typical year-end rise in demand for cash, particularly ahead of upcoming regulatory checks. So they're saying, hey, look, this is just because there's such a demand for cash that the banks don't have enough, so we want to make sure they do. But the real issue here is that money is leaving China, and in a big way, it's exiting the country. But notably, they mentioned ahead of regulatory checks. So what is it telling you? That they already know, the government knows that the banks won't pass the regulatory checks. So what are they doing? They're coming in, injecting capital so they can come back and say, hey, look, the banks are okay. Everything's good. Go and borrow and get the banks to lend. And yet we know the banks don't want to because the Chinese economy is getting worse. And when you start to see deflation ripple through an economy, the first thing the banks do, stop lending. And meanwhile, growing bets on further PBOC easing have pushed down yields on government bonds. Traders suggest the authorities' large-scale purchases of debt have contributed to the one-year sovereign yields falling below 1% earlier this month. And that's because people don't understand that interest rates are a function of growth and inflation expectations. And what the market is pricing in is a big plunge in the Chinese economy, and that means rates need to go down to incentivize people to go out and borrow, because in debt-based economies, money is created when people borrow, and that money is injected into the economy where it gets moved through the financial system. And so what we're seeing is the economy slowing down, rates falling, because if money is not created, if businesses and consumers do not come out and borrow in a big way, what you're going to see is a massive financial crisis upstart in China. You're going to see asset prices crash, markets crash. It's all because there isn't enough money in the system to support prices. But something we think is going up by as much as potentially 10%. While we look at U.S. equity markets and global markets and see them headed down as one of our hot trades from last year. And on Tuesday, it surged up. Now this trade, going back to December 23rd, is up 2.07%. And we gave all of our subscribers the notice. And this is a trade that I am personally invested in. And yes, I disclose my exact trading book to you, what I'm trading, when I'm trading it. And I even tell you ahead of time so you can make a decision if you want to buy or sell ahead of me. And then the day following, we issued a massive alert to our CTA Timer Pro subscribers. And that trade is up as well. In fact, most of our trade book is up. Now, what's the difference? Well, with Momentum Timer Pro, we take a look at the technical indicators. We aggregate them together with a proprietary overlay. We review the signals it generates every day, and I give you my opinion on the best ones, and I even trade off of these reports. Our CTA Timer Pro report, it looks at machine positioning, finds super deep signals that no one else finds. Again, fantastic reports. We review every signal every day. And again, full disclosure, you want to jump in on this trade with me and make some money while the market's melting down? Well, here's the good news. You get the reports, you get all the tradable signals. I give you my opinions on the best trades. We backtest our reports so we know our signals have a high probability of generating a positive return. We give you risk control levels, full tracking of trades and returns, a weekly update. And because some of you said, hey, Steve, I want to trade, but it's the new year. Can you extend it? Okay, we're going to extend the 30-day free trial for a few more days. Jump in on that because it's going away. And that means if you don't grab this, the first month will no longer be free. Links in the description below. Make money right alongside me, because analysts say that PBOC will likely continue ramping up outright reverse repo and government bond purchases to ensure adequate cash flow in the banking system as the economy faces an increasing threat from U.S. tariffs and persisting deflationary pressure. So notice how they're pointing the finger now at President-elect Donald Trump, saying, look, it's all because of him. You know, if he wouldn't put these tariffs on place, we wouldn't need this. We wouldn't have to do these liquidity injections. But the reality is it doesn't matter who they point fingers at. The Chinese economy is in the early stages of recession. The banks are insolvent. They're over-leveraged in the real estate sector that massively overbuilt, expecting the idea that if you build it, people will come. Well, the problem is they built it and the economy slowed down. And now Beijing doesn't have an answer because fiscal stimulus isn't working, monetary stimulus isn't working, and nothing's going to keep the Chinese economy from heading into a downward spiral that's going to upend its entire financial system and send the yuan plunging. And as we now see over New Year's, China's offshore yuan has fallen to the lowest since 2022. Now, mind you, this is in thin trading, but what can you expect as markets open on Thursday? As yuan goes down, what you're going to see is more speculators jump on the short side of this trade. They're going to want to break the Chinese government and its currency. But you think about this from a trading perspective. If you're engaged in trade with someone and they offer you yuan in exchange for your goods, well, why would you want to accept that? Because what you're seeing in the currency markets is a value going down. So if you do take it, you realize that the amount of money you're getting is actually going to decline in value until you get rid of it. The problem is no one on the market does want it. The reality is people are going to want dollars, and that's going to have a huge problem for the U.S. economy, because as other currencies tied to the dollar go down, well, that means the dollar is going to scream higher. For the U.S. economy, well, it's going to put a massive dent in our manufacturing sector as people look to source overseas, and that means many Americans are going to face an unemployment line with no opportunity to re-enter the workforce, as we're already seeing. And there was no apparent driver for the move, which was likely the result of thin volumes on final trading day of the year. Well, that's the excuse. There's some notion that Thursday morning people are going to just want to hold a lot of yuan. What they're going to see is an increasingly desperate Beijing is coming out, injecting liquidity into the banks. And what that means is they're going to cut rates at the PBOC at some point, and then the market's going to expect a weaker and weaker yuan. Watch the speculators pile on this trade to the downside. They want to break the financial system there, you'll see. Earlier, President Xi Jinping said China's gross domestic product is expected to expand around 5% for the full year of 2024. Well, I don't believe that, and I'm not sure if anybody actually does, but that's what the party is saying. Of course, they're going to publish a number that's going to look close to that, but in reality, China's economy absolutely stands no chance of hitting that target. And what we're seeing in the bond market and in the currency market and the reactions from the PBOC is telling us that China's economy is in far worse shape than the government wants us to know. But is a recent surge in services activity a ticking time bomb? Well, it jumped as stimulus lifted local demand. But one thing that we've noticed here is that stimulus isn't lasting that long. We've seen Chinese stimulus last only a matter of a couple of months. But the expectation is if they keep stimulating the economy, it's going to have a massive turnaround. But I don't think that's the case at all. And the official non-manufacturing purchases managers index rose to 52.2 in December, which is higher than forecast, marking an expansion with the zero line as 50. The growth supportive measures pledged in the last few months seem to be yielding. The momentum appears to have stabilized, and that's a key word. It's just stabilized. So what did we see happening in the global economy? We saw China's economy come down, and now it's just holding. And it's only because Beijing's coming in with stimulus, rates are going down, the PBOC is trying to do things. You're seeing all these efforts just to stabilize the economy. And what this means is the patient is very sick. The Chinese economy is not getting better. And as we go into the first of the year, what we know is global consumption tends to drop, particularly from U.S. consumers who start to get their credit card bills and realize it's time to focus on debt instead of consumption. There's likely going to be another leg down, and what we're going to find out is the stimulus is not enough to keep China's economy from heading into a recession. Increased policy support toward the end of the year has clearly provided a near-term boost to growth, and that's just it. A near-term boost, but the boost probably won't last more than a few quarters, and that's a fantasy, because what did we see from the real estate sector? They came out, put some support under it, and how long did it last? A whole month, not several quarters. And with Trump likely to fall through on his tariff threat next year and persistent structural imbalances still weighing on the economy, the boost is going to fall flat on its face. In fact, we know that if President-elect Trump does enact tariffs on China, or at least further tariffs on China, that is, there is no chance that the Chinese economy can turn around. It will plunge it into a deep recession. He knows it, and even better, they know it too. And evidence of that is right inside their home sales, as we now see December home sales stay flat and signs of stabilization. But again, it's all about stabilization. You note that there's hope. There's no sign of green shoots. There's no sign that the economy in China is turning around. What they're hoping is the patient is stabilizing, but in reality, it's hemorrhaging. They've got it all under control, at least for the moment. It's not going to last because China unleashed its strongest package of policies to boost the residential market in the past 3 months. And what did it do? It just led to stabilization. All it does is pull forward demand. And that's what stimulus does. And it's one of those problems that we see with it is it pulls forward demand from people who were going to buy anyways, but perhaps were waiting for a few months or something to change. They see the stimulus come out. It puts them in a mode to buy. What is hopeful, at least from a government's perspective, is enough people will come in and buy, spurring other people to buy. The reality is the Chinese economy is slowing at a rate that is not going to bring more people to buy because the global economy is continuing to slow. The government cut borrowing costs on existing mortgages, relaxed buying curbs in big cities, and lowered taxes on home purchases. It trimmed purchasing costs for people seeking to upgrade dwellings in some big cities. And so you can see all that did was, again, pull forward demand, because when we look at the Chinese manufacturing sector, it came in just over 50, meaning it was about 50.1, suggesting such a very slight expansion. But in reality, the Chinese manufacturing sector is just actually unchanged. Its growth rate is not moving. And this is a problem because if you want to see people come out and consume and buy homes, you have to give them confidence. And that means in the labor market, in their incomes, in their ability to pay on their debt and on any new debt they take on. But just a stabilization of the current place of the Chinese economy is not going to be enough to turn the tide. And we're seeing this now, this ripple effect of tariff threats spur all across the country. In fact, even at home, when at one point people were championing tariffs, now they're panicking. As tariff outlook starts to worry Texas manufacturers, let's take a look at this recent report. What are they saying? Tariffs are a concern. Widespread tariff risks are causing significant change in our business, and even worse, a potential loss of orders. And we've talked about the order book being critical. New orders are the lifeblood of a manufacturing sector. Now, when they get more than they can handle, they go into what's called a backlog. Those are not a priority. They get worked on later. But if you don't have a persistent incoming supply of new orders, eventually any backlogs get worked through. And for the U.S. manufacturers, they've been working through backlogs for about 2 years now. And at some point, they're going to run out. And without enough new orders to sustain the workforce, what's going to happen is hours are going to get cut even more, jobs are going to get lost. And based on what we're seeing across the U.S. manufacturing sector alone, people are losing their jobs and getting stuck on unemployment for over 3 months, indicating that there are no opportunities for them. And when that happens, people cut spending in a big way, and you start to see the downward spiral take effect. Here we see from food producers, talk of tariffs on imported materials are leading to big uncertainty. And how about in general, concern about international trade and supply disruption? Just because China is the world's largest exporter doesn't mean that we have companies that don't export to China and across the world that are afraid that these tariffs could damage the U.S. economy. Now, we're hearing this from Texas manufacturers, and they are massive employers. There's a huge manufacturing base in Texas, could lead to massive job losses, and not just in Texas. But as we turn to Europe, they're scrambling as well. In Europe, the European Central Bank Governing Council member Klaas Knot said he's concerned China may start selling its products to Europe at discounted rates if the U.S. starts a trade war by imposing new tariffs. And this is a major problem for European labor at a time when they're already seeing the effects of a slowdown in demand for automobiles, particularly on exports to China, which is causing manufacturers there in Germany to cut their production, cut workforce, and is having a huge impact on the economy there. And if China comes in and dumps goods at a lower price, you're going to see more German businesses fail. You're going to see more people out of work all across Europe. This is a dangerous sign because the big fear is that China is going to dump goods all across the world. What we're seeing now is people stepping in, political elites saying, look, we don't want this. We're trying to protect our labor force. The issue is demand around the world is plunging at a rate that tariffs aren't going to save domestic economies. In such a situation, there's a chance the Chinese will start offering their goods in Europe and at lower and lower prices. We're already seeing that happening in the steel market. In this way, China is, as it were, is exporting deflation to us. And so what we're seeing here is a setup in China that their currency could plunge, could cause an all-out crisis spreading across Asia, and then their banking system, if it goes under, and we believe it's highly insolvent, it's going to spread all across the world at a time when global demand is outright plunging. And this crisis, well, it could kick off as soon as tomorrow. And what does this mean for you and workers all around the world? Well, it means their jobs are no longer as safe as we thought and could lead to a mass unemployment and a global depression. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.